Warren Buffett is sitting on $350 billion in cash, while $7.3 trillion sits idle in U.S. money market funds, the largest cash hoard in American history. Every single time this has happened before, the economy didn't stabilize. It collapsed. $7.3 trillion. That's the number flashing red across the financial system right now, and almost nobody is paying attention. That's how much cash is sitting idle in U.S. money market funds at this exact moment, the largest pile of dormant capital in human history. And if you think that's a sign of strength or safety, you're reading the signal completely wrong. Because here's what history teaches us. Every time cash has piled up like this, the economy didn't get stronger. It crashed hard. A money market fund is essentially a type of investment account where individuals and institutions park cash to earn modest interest safely, similar to an enhanced savings account that invests in short-term, low-risk debt instruments. And right now, capital is flooding into these accounts instead of flowing into the real economy where it's desperately needed. To put this into perspective, it took 20 years from 1981 to 2001 for money market funds to grow by $2 trillion. This time, we added that same amount in just 2 years. The velocity is unprecedented. The chart showing this surge looks like a vertical line shooting into the stratosphere, sharper and larger than the buildups before the dot-com bust, before the 2008 housing crash, and before COVID-19. Here's where it gets dangerous. Most investors look at a cash pile like this and feel reassured. They tell themselves, at least people are being careful, at least they're holding cash for stability. But that's the illusion Buffett would warn you about. When trillions sit idle, they're not flowing into businesses, innovation, or growth. The economic system slowly suffocates. The pattern has repeated with brutal consistency. Late 1990s, cash surged, then the dot-com bubble burst. 2006 to 2007, cash surged, then housing collapsed. 2019, cash surged, then COVID froze the economy. Now, in 2025, the surge is larger than ever before. The oxygen in the financial system is thinner than ever. And the damage, the real structural damage, has already been done. Warren Buffett himself is watching this same shift unfold, and he's not chasing market highs or deploying capital recklessly. He's holding cash too. At Berkshire Hathaway's recent shareholder meeting, Buffett revealed something critical about his cash position and investment philosophy that every investor needs to understand. In the stock market, not everything moves at the same pace, and not everything that's rising is healthy. Right now, if you're only watching the S&P 500, things might look fine, maybe even great. A handful of mega-cap tech names are soaring. Headlines proclaim the market is in recovery mode. But as Buffett would say, the real story isn't in the headlines, it's in the fundamentals. And those fundamentals are slipping badly. Let's talk about small-cap stocks, the companies that don't grab the headlines like the tech giants do, but make up the backbone of the American economy. These are the local manufacturers, tech startups, regional suppliers, construction firms, the kinds of businesses that hire, build, and produce in the real world. Buffett has long emphasized the importance of businesses that generate consistent earnings rather than hype-driven valuations. And small-cap companies represent where genuine economic growth begins. However, they're struggling badly right now. Since 2016, small-cap stocks have been losing ground consistently, and despite a modest recent bounce, the long-term trend shows severe underperformance. The Russell 2000 index, which tracks small-cap companies, remains below its 2021 peak, while mega-cap tech stocks have inflated broader indexes, masking the deterioration underneath. This divergence is exactly what Buffett pays attention to, because when small companies fall behind, it's not just a market signal, it's a real economy signal. And here's why it matters so much. When interest rates rise, borrowing becomes expensive and growth becomes harder. Small companies, which rely more heavily on loans and less on stock buybacks, feel that pressure first. They slow down hiring, they delay projects, they cancel expansions, they stop investing in the future. This isn't just theory. The data proves it. The Conference Board's leading economic index has been declining. Orders for manufactured goods are down. Building permits have dropped, and the number of weekly hours worked in manufacturing has shrunk. That's people working less. That's projects not breaking ground. That's ideas not turning into businesses. Most investors don't even see this happening because headlines are dominated by artificial intelligence hype, big tech earnings records, and market rallies. But all of that is concentrated in one narrow corner of the market. The other corner, the one that actually powers local communities, middle-class jobs and real production, is flashing red. So what's behind this weakness? What's applying all this pressure? The answer is straightforward: interest rates. Buffett once described interest rates as financial gravity. The higher they go, the heavier everything gets. And right now, the gravity is intense. Since 2021, interest rates have surged from nearly 0 to over 5%, one of the fastest rate hiking cycles in modern economic history. And this isn't just impacting mortgages or credit cards. It's fundamentally shifting how money moves through the entire economy. Buffett has said that interest rates are the single most important variable in determining the value of every asset. And what we're seeing right now proves his point perfectly. When cash suddenly starts offering decent returns, 5% or more, it changes investor behavior completely. Why take risk on stocks, businesses, or innovation when your money earns solid returns just sitting still? That's what's happening now. Capital is fleeing risk and flowing into cash, safe, stable, simple. But it comes at a severe cost. The Conference Board's leading economic index, LEI, which tracks 10 key forward-looking indicators for the U.S. economy, has been in steady decline since early 2023. As of July 2025, the index sits at 98.7, down 2.7% year-to-date, and is now triggering an official recession signal. This matters enormously. The LEI includes metrics like new manufacturing orders, building permits, consumer expectations, and weekly hours worked, essentially measuring whether the economy's engine is accelerating or stalling. Right now, it's stalling. This is a symptom, not a surprise. When interest rates rise rapidly, two things happen almost instantly. First, consumers spend less. Mortgages cost more. Credit becomes tighter. People save instead of spending. Second, businesses tighten their belts dramatically. They halt expansions, delay hiring, cut back on capital investment. Research and development budgets shrink. Inventory gets slashed. That slowdown then appears in the data. Not immediately noticeable, but then unmistakably. And this isn't just about large corporations. Small businesses already struggling get hit the hardest. They can't refinance debt easily. They can't absorb higher input costs. They can't raise prices like large firms can. The slow squeeze continues relentlessly. It's not a crash, it's erosion, little by little. What's even more concerning is how disconnected this reality is from the stock market. While the real economy struggles, the market, especially tech-heavy indexes, keeps rising. Buffett has warned repeatedly against mistaking market signals for economic health. As he famously said, "Price is what you pay, value is what you get." And right now, prices are rising while underlying value is shrinking. This isn't just a short-term divergence. It's the widening of two separate realities: the financial economy and the real one. In the financial economy, you see rallies, AI hype, corporate buybacks, and investor optimism. But in the real economy, You see declining hours worked, flat wages, lower capital spending, and weakening productivity. Eventually, those two realities collide because sooner or later the real economy pulls everything back to earth. The financial system can only float so far above fundamentals before gravity, interest rates, reasserts itself with devastating force. There's one force that even Warren Buffett can't predict, can't control, and can't hedge perfectly against: oil prices. Buffett has frequently referred to oil prices as one of the most unpredictable and dangerous variables in the global economy, and history backs him up completely. Because while central banks can control interest rates and governments can influence spending levels, no one controls what happens when oil prices spike. And every time they do, something in the economic system breaks. Every major rise in unemployment since the 1980s has followed a surge in oil prices. Not because oil is magical, but because oil touches everything in the economy. It's embedded in how we transport goods, produce products, grow food, and deliver virtually every item in modern commerce. Looking at historical data tracking oil prices alongside U.S. inflation rates, a clear pattern emerges. Spikes in oil tend to precede or directly cause inflation surges. It's a consistent economy-wide chain reaction. Examining inflation-adjusted crude oil prices dating back to 1946 reveals that every major spike, from the oil shocks of the 1970s to the surge in 2008 and again in 2022, preceded or coincided with significant economic stress. When oil prices rise, transportation costs soar, profit margins shrink, consumer goods become more expensive, and eventually, companies cut costs, usually by eliminating jobs. Buffett understands that few companies or consumers can escape the cost structure that oil represents. According to recent global research, oil price shocks tend to result in sharp and lasting labor market consequences, particularly in countries like the United States. What makes oil so dangerous is that it doesn't require a financial panic to cause real pain. It just needs to move upward rapidly. And that can happen at any time, from geopolitical tension, supply chain disruptions, or simply seasonal demand shifts. Oil is the kind of variable that's invisible until it isn't. We don't notice it until it hits gas stations, grocery shelves, airline tickets, or freight rates. And by the time we feel it, it's already moving the economy. The economy, already wobbling under high interest rates and weak productivity, wouldn't need much of a push. Oil could be that push, because if oil begins to rise again, even modestly, it could ignite a system that's already dry and fragile. At Berkshire Hathaway's 2025 shareholder meeting, Buffett addressed his unprecedented cash position with characteristic bluntness. When asked about Berkshire's $335 billion in cash and short-term investments, representing about 27% of total assets compared to a historical 13% average, Buffett didn't mince words. "We would rather have conditions that are developed where we would have like 50 billion or something like that," Buffett admitted. But that just isn't the way business works. He explained that Berkshire would gladly spend 100 billion or more. Those decisions are not tough to make. When something makes sense, offers good value, and doesn't risk significant losses. Buffett was clear about the futility of market timing. Nobody knows what the market is going to do tomorrow, next week, next month. They spend all their time talking about it because it's easy to talk about, but it has no value. But he was equally clear about opportunity. "We will be bombarded with offerings that we'll be glad to have the cash for. It's very unlikely to happen tomorrow, but it's not unlikely to happen in 5 years, and then the probabilities get higher as you go along." This is the Oracle's final investment thesis in action: patience, discipline, and massive firepower held in reserve for when genuine opportunities emerge. So what do we do in the face of all this? First, stop panicking. Don't react emotionally to headlines. Don't chase rallies. Don't dump everything out of fear. That's how people lose. Right now, the game is about staying sharp, not getting shaken. You may not be able to reverse the damage, but you can stop making it worse. You can choose better, act smarter, think longer, and hold steady. The best asset isn't the balance in your portfolio, it's your perspective. That's where the real edge is. That's what Buffett is leaning on too. And that's completely in your control. Which approach will you take? Will you chase the rally and hope it continues? Or will you follow Buffett's lead? Share your thoughts in the comments below and subscribe for continued coverage of the investment strategies that separate successful long-term investors from the crowd-chasing short-term market movements.